Chapter 1. Revision. No new work can be added in accounting before you are certain that you understand all the previous work that's been done. Ensure that you fully understand all the work covered in grade 10. Refer to your workbooks from grade 8, 9 and 10 when and where necessary. Ask your teacher to explain any aspects that you are still uncertain of. So the following revision exercises should give you a clear picture of whether you understand the previous work and which aspects need more attention. So exercise 1.1. Analyze the following transactions using the headings given in the answer sheet. Take note. Adjustments must be done on the 28th of February 2018, the end of the financial year of the business, and all calculations must be rounded off to the nearest rand. Number 1. The bank statement shows the following deductions: service fees, cash handling fees, and checkbook fees. Now remember, these are all fees charged by the bank. So we give them a collective name known as bank charges. So think about your two accounts. One account must be bank charges and the other account is then bank. So when we go to our accounting equation, account debit and account credit. Now bank and bank charges. Bank, think about bank first, it's the easier one. I want to decrease my bank, therefore bank needs to be credited. So when I decrease an asset, it means that my assets are subtracting or crediting with 550 rand. The other account is then bank charges. You may not call it by 3 different names. The check handling fees, the checkbook fees must be a collective name known as bank charges. Bank charges, owner's equity. In owner's equity that debits means it is subtracting from owner's equity. CPJ is your journal and your source document, as I said, was bank statement. Number 2. Goods were sold on credit to a debtor 10,125. A profit margin of 35% on cost is maintained throughout. So before we carry on, remember when anything is sold, we need to work out the cost price as well. So let's go and do that first. So remember, your calculation is cost price equals 100 over 100 plus markup times your selling price. So it gives you a cost price of 7,500. So first the 10,125, the selling price, needs to go into your books as sales and debtors control. So think about what happens to sales and what happens to debtors control. Sales is an income account. Therefore an income account is always credited so that your owner's equity can show an increase of 10,125. Debtors control is an asset. So an asset that is now being increased means that more debtors have bought from us on credit. So therefore my assets increases as well. Then your cost price goes into your books as cost of sales and trading stock. Now before the stock was sold, it was just known as trading stock in my books. Now that it is sold, I remove it from trading stock, meaning that trading stock needs to credit. So my assets decrease to 7,500 and I move it into the expense account called cost of sales. And cost of sales is an owner's equity expense that is then on the debit side of owner's equity. Number 3. A check of 9,025 was received from the debtor. So that, in other words, is the check amount, 9,025. In settlement of the account, after 5% discount was allowed. So we need to go and work backwards to find the 5% discount that was allowed, because we need to record both the check amount as well as the discount amount. So therefore, if we go and work out your 9,025, that is only 95%. The 5% was already subtracted from that. So I multiplied with the 5% on top over the 95, and that leaves me with an answer of 475 Rand, and that is then the discount amount that was allowed. So 2 entries are needed. First entry for the check amount. So what happened was they gave me the money, so in other words my bank increases, assets increase with 9,025. Then debtors control decreased with 9,025, which is also an asset that is decreasing. Then the discount is also subtracted from my debtors control account because he's paid as well as he got discount. So his account decreases even further with 475 Rand. The reason why it's decreasing further is due to discount that is allowed. And discount allowed is known as an expense account in my books. Number 4, stationery was bought on credit, 12,000 Rand. So stationery and credit. Stationery, if I buy on credit, then it's creditors control. So therefore, creditors control, think about what needs to happen to creditors control. It's a liability that needs to increase. So when I increase my liabilities, I need to credit my liability. So therefore, creditors control will be my account, credit. Then stationery is an expense account, so owner's equity is debited with 12,000 Rand. Number 5, a check of 3,500 was issued to a creditor in settlement of the account of 3,800. So settlement means we paid the account in full. So therefore the difference between what I see there, what was paid, versus what the amount is that was taken off of my account, the 300 difference is then discount that was received. So 2 entries again needed. First, I need to show that my account is decreasing, so therefore creditors control is decreasing my liabilities with 3,500. The reason being is that bank paid for the money, 3,500. But my creditors control account decreased even further with a further 300 Rand. So discount received 300 Rand. Discount received is known as an income account, so therefore it makes sense that it's increasing my liabilities of my owner's equity on the credit side. So owner's equity is increasing and my liabilities are decreasing even further. Number 6. The check received from a debtor earlier, number 3, was returned by the bank marked RD. Now remember, in number 3, we also allow discount. So it's not just the check that needs to be cancelled, but also the discount that we allowed. So therefore, 2 entries are needed. Firstly, we cancel everything that was done in number 3. The debtors and the bank just gets reversed. So debtors will now be debit and bank will now be the credit. So therefore, the effect of that is that debtors account increases again with the 9,025 and my bank decreases again with the 9,025. Then also the discount needs to be cancelled. So the discount that was allowed now gets cancelled and the debtors control gets cancelled as well. So it's literally just a reverse of what was done in number 3. So when we do that, our debtors control increases with the discount amount of 475 Rand, and our discount allowed, which was an expense, now gets increased again. So our owner's equity increases because the discount was cancelled. Just also pay attention, the first entry would have been done in the CPJ, whereas the second entry would have been done in the general journal. Number 7, an amount of 50,000 was invested at ABSA on a fixed deposit at an interest rate of 4.5%. The interest rate is not important right now. We first need to do the investment. So when we invest, the money needs to leave my bank account to go into the investment account. So bank needs to decrease on the credit side. therefore creating an asset that is called fixed deposit from Absa. So the money is leaving my asset to create another asset called fixed deposit. Number 8, the previous fixed deposit at FNB has matured. Matured means that it's expired, so it's been paid back to us. The original deposit was 25,000 Rand, and a check was received from FNB with the amount of the deposit as well as interest for the last 3 months at a rate of 4%. So if we go and work out the interest first, interest is very simple. It's 25%. Times 4% times, we only had it for 3, it's only interest for 3 over 12 months. That leaves you with an amount to be paid of 250 Rand. So in other words, when we go here, 2 things happening. First, the deposit is maturing. So bank is increasing again with the 25,000. And therefore, the fixed deposit at FNB is decreasing with the 25,000. So in other words, this fixed deposit has now closed down. It doesn't exist anymore. Then also, bank is increasing furthermore with an extra 250 Rand as well. Why? Because of interest on fixed deposit. And interest on fixed deposit is known as an income. So owner's equity is increasing with 250 Rand. Both of these will be recorded in the CRJ with a duplicate receipt. Number 9, the bank statement reflects a credit entry in respect of interest on our current account, 760. Now, credit entry means it's a positive entry in our bank. Therefore, our bank is increasing. So, if our bank is increasing, we need to put that entry in on the debit side of bank. So, bank is increasing with 760. The reason being interest on current account. And interest on current account, same as interest on fixed deposit, is known as an income in my book. So my owner's equity is increasing on the credit side. Number 10, the loan of 80,000 was obtained from Nedbank at an interest rate of 9%. Now again, the interest rate is not important right now. The loan that we are getting, that is what needs to be recorded first. So when a loan is obtained, a loan is created in my books as a liability. So a liability that's increasing means it needs to be on the credit side. So therefore my liabilities are increasing with 80,000 Rand. Now that money will be paid into my current bank account. Therefore bank is also increasing with 80,000 Rand. The interest is not being paid right now, so we don't need to show that. Number 11, we issue a check for goods purchase, 16,000. So a check, that is bank, goods, that is known as trading stock, and that's being purchased. So in other words, my trading stock is increasing because I now have more trading stock than what I had before. So in other words, trading stock that increases needs to be a debit entry. So increasing my asset was 16,000. Then I'm paying for these goods, so therefore bank is decreasing, also an asset, but this time the asset is decreasing on the credit side, 16,000 Rand. Number 12 links up with number 11. This is an important one. Issue a check for delivery of the goods, 900 Rand. Now remember, delivering of goods goes to the trading stock account as well because it increases the price that we had to pay for the goods. So therefore it's again trading stock and again bank. So this looks very similar to what we've just done. Just remember, delivery charges are also added to trading stock, so my trading stock account increases again with 900. We paid for it out of bank, so my bank is decreasing with 900 as well. That's a very important one. I hope you had that one right. Number 13. Issue a check for the first installment on the loan to Nedbank, 5,300. This amount includes the interest on loan for the first 3 months. So we first need to work out the interest. Now remember, the loan we got was for 80,000. 9% interest is what they charge us, but for 3 months that gives you an amount to be paid of 1,800. So in other words, of this 5,300, 1,800 of that is for interest and the rest is for the loan. So when we go to the transaction, it's recorded separately. So my bank is decreasing with the amount of 3,500, and then my loan account is also decreasing with 3,500. So in other words, my liability is debiting with 3,500. So the rest of the money was also taken out of bank, so a further 1,800, but this time the 1,800 was to pay off the interest. And remember, interest is an owner's equity expense, so it's decreasing my owner's equity on the debit side, 1,800 Rand. 14. The bank statement further reflects an amount of 1,300 regarding interest charged on overdue account. So when interest is charged on an overdue account, remember the CPJ is used. Bank statement is my source document. My bank is decreasing, so assets are decreasing on the debit. Oh, it's an overdraft, so in other words, my liability is increasing with 1,300. Then interest on overdrafts is an expense account, so my owner's equity is also increasing or decreasing with 1,300. My expense account, therefore, is gaining 1,300 Rand. Number 15. Credit note was issued to a debtor for goods returned 1,620. Now remember, when goods are returned, that's the selling price, but we need to also record the cost price. So we need to go and work out the cost price, and we're going to keep on working with the percentage as they said in the beginning, 35% markup. So let's go and calculate the cost price. So cost price calculation, 100 over 100 plus markup times selling price of 1,620 gives you a cost price of 1,200. So when we record this, we need to first record the selling price. So exactly the opposite of what was done when we recorded it in the DJ. So the DJ entry there is our DJ entry. So our first selling price is cancelled. So sales gets cancelled in debtors allowances, and debtors control cancels in debtors control. So our debtors control will be our account credited, so that we can decrease our asset with 1,620. Then debtors allowances gets debited, so that's an expense account that is decreasing owner's equity on the debit side. Then cost of sales, which were the debit in DJ, is now the credit, and trading stock, which was the credit, is now the debit when it gets to a DAJ entry. So DAJ is the complete opposite of the DJ. So trading stock causes my assets to increase with 1,200, and cost of sales causes my owner's equity to increase as well. It's actually the expense that was cancelled, so expense that got cancelled is positive towards owner's equity. Number 16. A debit note was issued to a creditor for goods returned 2,100. So when goods are returned to a creditor, we give a debit note. So let's see what it looks like in terms of our books. Remember, when we return goods, we use the CAJ as our journal, duplicate debit note. We're decreasing our creditors control, and we are decreasing our trading stock. So decreasing creditors control means a debit in liabilities, and then trading stock is an asset that gets decreased on the credit side. So that's a credit in assets, 2,100. The account of a debtor who owes us 450 must be written off. So when we write off an account, think about the two accounts needed. Remember, He's a debtor, so obviously I'm going to use debtors control. What other account? The other account that I'm using is a new account that you learned in grade 10, and that's called bad debts. So bad debts is an expense account, so that needs to be debited, and I'm decreasing my debtors control on the credit side. So assets are decreasing, owner's equity is also decreasing with 450 Rand. Number 18, almost halfway. The owner took stock to the value of 3,510 for personal use. So 3,510 taken by the owner. Remember, when the owner takes anything, that is known as drawings. So my account to be debited is drawings, and trading stock is decreasing on the credit side. So credit in assets causes a decrease in assets. Drawings causes a decrease in owner's equity as well for 3,510. And the journal to be used is called the general journal. Number 19. The account of a debtor owing 3,000 must be charged with interest 12% for 6 months. So let's go and calculate that interest. So if it's 3,000 times 12% times 6 over 12 gives you 180 Rand interest to be charged onto that debtor's account. So the accounts to be used, remember, debtor's account is now increasing, so debtor's control is our account debit, causing an asset of 180 increase. Then our account to be credited is called interest on debtors or interest on overdue debtors, and that's an income, an owner's equity income account that's increasing owner's equity on the credit side. Number 20, stationery to the value of 800, which was returned to a creditor, was accidentally posted to the account of fuel. So when I return, I'm going to post it as a return in fuel, and that was 800 Rand then on the opposite side of where I record when I'm buying fuels. In other words, that's a credit entry in the expense account. But that is wrong. I was supposed to credit stationery. So therefore I need to take it out of fuel by adding 800 Rand in fuel and then taking it out of stationery. So the debit is in fuel and the credit is in stationery. It's always easier to plot what you are doing when it comes to errors. So account to be debited is fuel, causing a decrease in owner's equity. Account to be credited is stationery, causing an increase in owner's equity. Nothing happens in liabilities and assets. Then number 21, the amount of 1,100 was received from a debtor whose account was previously written off. Now, very important, from a debtor whose account was previously written off means that this is not a debtor anymore, so I cannot take this information to debtor's control. Instead, I go and create an account which is called bad debt recovered. That's an income account causing my owner's equity to increase with 1,100. The contra account is going to be bank because the money was put into bank, increasing bank as well. 1,100 in assets. Number 22. Depreciation on equipment must be brought into account at 20% per year according to the fixed installment method. That's the cost price method. So the cost price of the equipment is 560 and the balance in the accumulated account is 490 as it were the beginning of the year. So 560 minus 490, that gives you a carrying value of 70,000. Keep that in mind. Let's go and calculate the depreciation. So depreciation on the equipment, 560 times my 20% for the entire year leaves you with 112,000 depreciation for the year. But we calculated our carrying value to be 70,000. So because of that 1 Rand rule that says that we may not depreciate more than what is left of our carrying value, it means that this 112,000 is too much to depreciate. So we're going to use instead our 70,000 carrying value minus 1 Rand. So that leaves our depreciation to be 69,999. So in our accounts, depreciation is always done in exactly the same way. Depreciation debited, accumulated depreciation credited. So depreciation expense 69,999, and then negative asset 69,999 as well. So my assets are decreasing, so is my owner's equity. Number 23, depreciation on vehicles is written off at 10% per year on the diminishing balance method. So that's the carrying value method. The business owns only one delivery truck, and the truck was bought on the 1st of June 2016 at a cost of 480. So we've had it for little over a year now. So when we go and work it out, we need to go and work out what was the previous depreciation as well as this year's depreciation. So previously we had 480,000, no accumulated depreciation, times 10%, and we only had it for 9 months, from June up to February. So that was accumulated depreciation of 36,000 Rand. So that, in other words, was what my balance would have been on for accumulated depreciation. So for this year, I had a carrying value 480 minus 36,000 times my 10%, and that leaves me with depreciation of 44,400. So what I need to record now is only the 44,400. Remember, I only calculated that to be able to get the correct carrying value to be able to work out this year's depreciation. So depreciation done in exactly the same way. Depreciation debited, accumulated depreciation credited. My expense account in owner's equity is 44,400, and my negative asset is 44,400 in assets as well. Number 24, rent expense for January and February is still outstanding. So therefore it's an accrued expense, expenses payable that we are wanting. Now the rent expense was 18,500 per month, but it increased by 8% on the 1st of January. So if we calculate the increase, it used to be 18,500, so you times it by 1.08 to get the increased amount, and it's outstanding for 2 months. So therefore the full expense that we are still wanting is 39,960. So in our accounts, we are waiting for that, and we've had to pay that expense. So therefore rent expenses are account to be debited, because we're creating the expense of 39,960. Then accrued expenses, you could have also called it expenses payable, which is a liability account, causes my liabilities to increase with 39,960 as well. Number 25, interest on the fixed deposit, shows that a total amount of 12,000 was received for interest during this year. So we need to go and check whether that amount is correct or not. So the information is as follows. We had 250,000 invested as it was the beginning of the year at an interest rate of 6% per annum. Then on the 1st of November, the interest rate decreased by 1.5%, and then furthermore, we decreased our investment with 50,000 on the 1st of January. So in other words, for the first 8 months, we had 250,000 invested at 6% for 8 months. So that leaves you with 10,000 Rand interest. Then for the next 2 months, our percentage dropped to 4.5%. So therefore it's still 250,000 invested at 4.5% for 2 months, and that's 1,875. Then our interest rate stayed the same, but our investment dropped by 50,000 to 200,000. So therefore 200,000 times 4.5% for the last 2 months, that is 1,500. So all in all, we had to receive 13,375. So there's some of this outstanding if you consider what we've received at 12,000 Rand only. So in other words, 1,375 is outstanding. So we add it to our interest on fixed deposit, 1,375. Then that 1,375 is also added to an account that we call accrued income. You can also call it income receivable. That's known as an asset account. So my assets increase with 1,375 Rand. Number 26. The insurance premium has already been paid up until the end of June. That's 4 months extra. So the total amount is 65,600. So if we calculate that, 65,600 in other words is for this year as well as 4 months extra. So if we take that amount and we times it by 4/16, we're going to get the 4 extra months to be 16,400. So that in other words is a prepaid expense that we need to go and cancel or take out for this year. So in other words, my insurance account needs to decrease with 16,400, and therefore I'm taking the information to deferred expenses, also known as prepaid expenses. 16,400, and that's an asset that is then increasing with 16,400. Number 27, rent income shows a total of 131,195. The rent for March 2018 has been received. So the monthly amount for rent has increased by 9% as of the 1st of July. So when we go and work this out, it's quite a difficult explanation or calculation. Now firstly, for 4 months we only received X. Thereafter, for the last 9 months, 8 months which falls in this year and 1 month extra, we received X plus 9% of X. So an extra 9%. And that equals to the 131,195 total rent received. So therefore, if we get X alone on one side and we divide it by the other side, we see that our X amount is actually 9,500. So that is before the increase. So if I put the increase with that, I see that my increased rent amount is 10,355. So therefore, that is the amount to be taken out of rent. So when I take it out of rent, I need to debit my rent income account so that I can decrease my owner's equity with 10,355. That amount then goes to deferred income. Deferred income, also known as income received in advance, and that's a liability that increases with 10,355 Rand. Number 28, a check, which means that the money left my bank, of 45,900 was issued to SARS for monthly tax deductions for salaries and wages. So my bank is decreasing because it's a payment made. So bank is my credit account, decreasing with 45,900. Then the account that I'm paying is called SARS Pay As You Earn, and SARS Pay As You Earn is known as a liability account. So my liability is debited, which causes a decrease in my liabilities of 45,900. Number 29, it was discovered that trading stock to the value of 3,375 had been stolen out of the shop. So when something is stolen, I take it to an account called loss due to theft, and that's an expense account. So therefore my expense account debited, loss due to theft, causing my expenses owner's equity to be debited with 3,375. The stock then also needs to be taken out of trading stock, which is an asset that I'm decreasing 3,375 Rand. 30. The trading inventory account reflects 65,000, but a physical stock take was done on the 28th of February, and this reflects trading stock of 59,000. So the difference between the two tells me that there was a trading stock deficit of 6,000 Rand that I need to go and correct in my books. So therefore, when I create a deficit, trading stock deficit is a debit account, causing my owner's equity to decrease with 6,000 Rand. Account to be credited is trading stock because I want to decrease that as well with a further 6,000 Rand. So therefore my assets as well as my owner's equity is decreasing with 6,000 Rand. 31. The total of 86,000 was spent on stationery during the year, but stationery to the value of 82,600 was consumed during the year. So this is important. The amount that I'm consuming, that is my expense for the year. So what was spent tells me then that I've overspent on expenses, which means that I've paid for something that I did not use in this year. So therefore the difference between these two amounts tells me how much stationery is still on hand to only be used in the following year. So therefore the difference goes to the account called consumable stores on hand and is taken out of stationery. So stationery decreases with 3,400 and consumable stores on hand, which is an asset, increases with 3,400. Number 32, provision for bad debts must be reduced by 680. So if I reduce a negative asset, it's a good thing because I'm reducing something bad in my books. So therefore reducing means that I'm creating an income. So provision for bad debts will be reduced and that causes my assets to increase with 680. Then provision for bad debts adjustment is the credit account, which is an owner's equity, and an owner's equity that gets credited means my owner's equity is increasing with 680 Rand. Number 33, debtors allowances 22,000 must be closed off to sales account. So that's my first closing entry. So when I close it off, I simply take the debtors allowances out of the account by crediting it, causing my owner's equity to increase of 22. If I take that, I move it into sales, which is then going to be debited. And a debit in sales means that owner's equity is decreasing with 22,000. 34. The net sales for the year is 877,500. We must transfer the gross profit from the trading account into the profit and loss account. Now before we can do that, we need to first calculate what the gross profit were. So if 877,500 is the sales amount, then we can calculate the profit from that. So sales times our markup percentage, which is 35% over 135, gives us the gross profit to be 227,500. So we take that from trading and put it into profit and loss. So my trading account is debited, profit and loss account is credited, and both of these are known as owner's equity. So my owner's equity is increasing and decreasing with 227,500. Our last entry then says the net profit percentage on turnover is 14%. This needs to be transferred, the net profit from profit and loss, into the capital account. So we first need to go and calculate the net profit. So in other words, if our sales amount again is 877,500 times 14%, that's the net profit. That tells me the net profit is 122,850. So that net profit needs to be transferred from profit and loss into capital. So I'm taking it out of my profit and loss account, which is going to be a debit, into capital, which is the credit. So I'm decreasing owner's equity and then I'm increasing capital again with the 122,850. I hope that you had most of these transactions right. in your revision exercise.